Here is a concise, approximately 350-word English summary of the core argument. The current AI investment boom is increasingly being compared to the financial excesses that led to the 2008 subprime crisis. The key argument is that AI is no longer just a technological revolution, it is becoming a new financial structure driven by Wall Street, private equity, or shadow banking. After 2008, traditional banks were heavily regulated, reducing their ability to take on high leverage and risky lending. However, this did not eliminate speculative capital demand. Instead, it shifted toward less regulated shadow banking institutions such as private equity funds, hedge funds, and trusts. These institutions now channel large pools of capital from pension funds, endowments, and insurance companies in search of higher returns, often targeting 15%到 20%, far above traditional equity market returns. In this environment, AI has become the new premium asset class. Major AI firms and infrastructure companies are raising massive funding rounds, increasingly backed by private equity giants. In some cases, AI companies are also forming joint ventures with these financial institutions to provide consulting and AI transformation services to thousands of portfolio companies. The concern is that this creates a circular financial structure. Private equity firms control large networks of software and tech companies, which then become clients of AI consulting ventures they indirectly own. Revenue is generated through internal contracts, boosting financial statements on both sides. Meanwhile, real operating companies may be pressured by fees, restructuring, or cost-cutting, weakening their long-term fundamentals. This structure resembles leveraged buyouts seen in past cases such as Toys R Us, where companies were acquired using debt, stripped of assets through fees and financial engineering, and ultimately left bankrupt while investors profited. The broader historical parallel is the 2008 subprime crisis, where risky mortgages were packaged into complex financial products and sold globally as safe assets. Today, the argument is that AI narratives and equity structures are being similarly packaged and sold to institutional and retirement capital. The key risk lies in dependence on continuous capital inflows. Many AI companies still lack stable profits and rely heavily on funding cycles. If liquidity tightens or institutional investors pull back, the structure could face sharp correction. Ultimately, the question is whether AI represents a sustainable technological revolution or another financial cycle driven by leverage, narrative packaging, and liquidity, with risks ultimately borne by ordinary investors and pension savers.